In the energy quadrant today, the fall continues in crude oil. Since July 11th, when crude oil opened up above 60 and then closed a cent lower, it opened at about 60.44 and then closed at about 60.43, we've got 6 consecutive days lower. Today's 3% move. On the lows, it was more than 3% on the lows, finishing down around 2.75%. Again, that caps 6 consecutive days lower. We now have what essentially is close to an outside week in crude oil. Obviously, we've had lower lows this week. We are at Thursday, so that's confirmed. Higher highs, we missed that by 2 cents. So we don't have a technically correct outside range day, but the fact that we opened up near the highs, fell just short of the highs, and then looks like we're going to close on the lows depending on how tomorrow behaves. We do have Baker Hughes rig counts coming out tomorrow. It's a pretty technically correct extension to the downside, and short of a geopolitical event, it's likely that downside is going to continue. Speaking of geopolitics, Iran said it can close the Strait of Hormuz, but it won't. Part of the reason the downtrend today, or the sell-off today, accelerated, that geopolitical risk seems to be taken out by the main geopolitical actor involved in that risk. If Iran's not going to close the Strait of Hormuz, they gave their own economic survival as the reason, then that whole geopolitical spike that we got up above 60 is taken out of the equation, and we're now back to just traditional supply and demand metrics, which right now looks like the demand metrics are taking over, especially when you look at yesterday's gasoline build. The gasoline build yesterday added to what looks like it's going to be a glut as the summer driving season peaks. We don't currently have a gasoline glut, but refinery utilization has been elevated, and the refinery buildup that we're seeing in gasoline and distillates, along with the potential slowdown, the global economic slowdown that seems to be on the horizon, looks like that gasoline glut that we saw at the beginning of the year might resurface, pushing gasoline prices down, pushing crude oil prices down, and then pushing that supply of crude oil out as well. That's going to be against what OPEC hopes for. But then you look at what's going to happen in the latter half of 2019, the beginning of 2020, with more pipeline capacity here in the U.S., that will encourage some more continued drilling by the shale patch here in the U.S. as the cost of pipe goes lower and lower. That means their break-even cost goes down as well. So right now, big problems for OPEC in terms of trying to drive prices higher with that geopolitical risk being taken out by Iran.